The first valuation methodology that's very commonly used, and the terms are often thrown around, is the PE ratio. The PE ratio is a price-earnings ratio, and what it does is it takes the price of a stock and divides it by the earnings of that company per share or per stock. So in other words, if a company has a stock price of 20 and it has earnings of $2 next year, then the PE ratio of that company will be 10 based on next year's earnings. Now the PE ratio therefore is calculated by taking the price of a stock and dividing by the earnings per share of that company. Another way of doing it would be to take the market capitalization of the entire company, i.e. the number of shares times the share price, so the total value of the total market value of the equity, and dividing it by the net income or the total earnings of the company. And the two will give the same answer, because in the one case we're doing it at a stock level, in the other case we're doing it at a company level. But basically, simplistically, it seeks to provide information with respect to how much we're paying for each dollar or euro of earnings for that company. So if we're paying, if the PE ratio based on next year's earnings is 5, then we're paying $5 for every dollar of earnings, or 5 euros for every euro of next year's earnings. Now, all other things being equal, what we'd obviously like to do is pay as little as possible for a dollar of earnings. Earnings are what is left over after all expenses, including operating expenses, taxes, cost of goods sold, interest, and so forth, and ultimately are what is kept within the company potentially, or paid out as dividends for the shareholders. So the earnings are what the shareholders benefit from, either in the form of dividends or in the form of retained earnings on the balance sheet. Now, all other things being equal, we would like to pay as little as possible for each dollar or euro of earnings. But there are a number of drawbacks with this methodology, as we'll see. The first one is that the earnings of a company in 1 year don't provide the full picture on that company. For example, a company that has very low earnings, say next year, because it still has its products in development, but then in the following year is expected to have very, very high earnings, and the following years continuing on at high earnings, looking at purely next year's PE ratio would not give you a good idea of what that company is doing. Or a company that's in a very poor environment and that has good earnings this year, but earnings are expected to fall dramatically next year, if we looked at this year's earnings, we would not get the full picture on that company. And that's a huge drawback, because we're only looking at 1 year of earnings, and those earnings clearly do not capture everything about that company. The second drawback is that earnings are an accounting term, and in that respect they reflect the last line of the income statement, revenues minus cost of goods sold and other expenses, operating expenses, interest, taxes, and so forth. And on that accounting statement, there are charges that are non-cash related, such as depreciation, which is a charge that we take to reflect how much of an item we might be using up in a given year. So if the company buys a piece of equipment which has an accounting life of 5 years, then we would charge 1/5, the company could charge 1/5 of the cost of that item as depreciation each year into the income statement, even though that's not a real cash charge. The cash charge would have been taken perhaps in the first year when the item was bought. The other thing is the company might take write-offs or make reserves for future losses, or have a year where it has an extraordinary expense related to a lawsuit or related to other things, and that would depress the earnings quite significantly, and again would lead to having earnings that are not reflective of the overall state of that company, or even of that year's performance, if, for example, that they decided to make take certain expenses or leave out certain expenses in a given year. And so that's the second major drawback with the PE ratio, that the earnings are an accounting term and an accounting calculation that can be quite volatile based on what happened with that company and the way it accounted for certain things in a given year. But that's the PE ratio. It can be one input into a valuation conversation. It is ultimately not conclusive in the sense that one can expect to capture a full picture of the company's valuation based on it, but it's certainly worth knowing what the PE ratio is and using it as credibility check of what that company's valuation could be. And since it's so commonly used, certainly worth knowing what it involves.